Hey, good evening. Hope you're all doing well. Wanted to pick up where we left off in life insurance. Want to quickly remind you, last time we met, last lecture, I was talking about two options. You have a permanent life insurance option, which we call whole life, or an ordinary life insurance where it has some kind of long-term, it is essentially available to you the duration of your life, and you are paying premiums accordingly for that benefit. Also has a savings component, what we'll talk about in a moment. Last time we focused on that temporary life insurance option. That's where you buy for a term or a period of time, limited period of time, premiums so that you have death protection for your beneficiaries in the event that you die prematurely. So a little bit focused, I'm going to go back and share my screen with you all. Basically, we're going to cover the whole life insurance side of it. Don't want you to get hung up in all the variations that I'm going to cover, but I do want you to know what options are out there. And I don't want you to think that I am completely against buying a whole life insurance. I know you saw some videos where it gave you probably more of one perspective. It obviously has its purpose, and it has a market for it. Not everyone understands what the difference is. They may only have been told about one option, which is the whole life and ordinary, and they pay in their hard-earned money into a pot thinking that's all that they can buy. They don't realize that there's a cheaper option out there to provide them higher levels of protection. So real quick, whole life, or another term for that would be ordinary life insurance policy, is that one that provides lifetime protection, and it doesn't say in the slides, but it usually covers you to the age of 121. Why that number? I have no idea. Doesn't make sense. Most people don't live to 121, but anyway, good to know. It has a cash value as well. So you are paying in money, and it has a cash out value. You have the ability sometimes potentially borrow money out of it, and you obviously have to pay it back, as you've learned some of the short clips. But it does have a cash value, so you're not giving it all to the insurance company. They do get to make a profit. They do get to cover their expenses, but they also get to keep some of it, and you get to get some of it back. So not a bad thing. The only thing I would generalize say is that people that are going to buy a whole life insurance policy or ordinary life insurance policy either have been misguided into thinking that's what their options are, or two, they want that savings component and they want lifetime protection for whatever reason. Maybe they have a legacy, they want to leave additional money to their children or their heirs. Maybe they want to make sure that their spouse is taken care of way beyond the age of 70, which we talked about last time. Term life insurance usually ends at the age of 70. You usually can't continue to buy it. It's too cost prohibitive. But whole life will carry you throughout your entire duration if you live to the age of 100 or 105 for that matter. What you'll notice here is that there's lots of different variations here. Don't want you to get hung up on those as well. We'll just go through them fairly quickly. So again, difference, I'm going to use them interchangeably, but whole life, ordinary life, I'm going to use them as the same term. When people think of life insurance, most of them are talking about whole life. I want to make sure people are aware there's a major difference, and having temporary is not a bad thing. Some people are only buying that peace of mind of having death protection. If you want to buy something that gives you something beyond that, you can go ahead and look into this option. Again, level premiums, they're much substantially higher premiums than you would pay on a term policy, but you can pay a level premium that provides you lifetime protection if that's what you choose. For the entire period you're paying them, you're going to pay the same amount. If you're paying over a shorter period of time, obviously you're going to pay more, but either way, you are paying the same amount no matter what your age or health. There is something called, so in the early years when you're paying into a policy, obviously the monies that you contributed toward this face value, let's say it's a $100,000 policy, you haven't paid in enough to cover your potential risk. Your insurance company is taking on more risk, and obviously they're going to be inadequate premiums paid in the early years, but they're going to get higher premiums in later years after you've caught up to that legal reserve. That legal reserve represents the liability that they have to you as the holder, or your beneficiaries as the holder of this policy, that would offset the insurance policy premiums that they've been paid in and are investing. And the net difference between that legal reserve and the face amount of the coverage, so that $100,000 face value versus what you've paid in as a legal reserve, that's your net amount of risk for the insurance company that they're taking on. This particular slide shows that. I think it was showed in maybe one of the other clips that I provided to you. But you'll notice if you were to open a policy at the age of 30, you have an insurance company that's taking on a lot more risk. If you died at the age of 31, they're going to have to pay out $100,000 and you've only paid in a small amount of premium. So they're taking on a lot larger amount of risk. If you live past the midterm, maybe around the age of 70, you'll notice that the amount of premium or value at risk is much smaller, but you're getting a much larger savings component. It's growing, and so you actually have more monies accumulated. Another key characteristic of whole life is that it has the potential to accumulate a cash value that you can draw out. One, either you could pay it in and borrow against it, or later you could surrender it, meaning I want to build up money, and eventually maybe when I'm 60 or 65, I may want to take a special trip or provide for something or pay off a mortgage, and I have value that I built up in this life insurance policy that I could just get cash out. That's what a cash surrender value is. It's going to grow over time. It tells you, it's no different than having an investment portfolio. It says, this is the value of your portfolio today. If you draw it out today, this is what it's worth. If the market goes down, it's a little bit more volatile in the stock market. Whole life insurance policies are probably a little bit more stable. So that's a benefit of it. So again, in the early years, you're overpaying for the insurance protection, meaning you're paying in and they have a lot more risk. You have that right to borrow money against it, but not until the later years. You'll see in a table later on. And again, it provides lifetime protection. The main problem with the policy, in my opinion, is people are buying something that they can afford. So if they buy a whole life insurance policy for $100,000 because that's all they can afford in monthly premiums, they're going to be substantially underinsured. As I showed you before, you could easily buy $1 million policy for much less money that really gives your family the protection you want it to have to pay for any expenses in college funds or anything to raise the children. Comparison of I can only afford a certain amount, and it's going to be it's going to leave me underinsured. So if you wanted to go with the limited payment option, that is, you pick a period of time. Maybe you decide for the first 10 years when I'm young and I don't have a family, I want to pay in larger premiums for a 10-year period of time. I pay those fixed premiums every year or every month if you want to pay them monthly. And then you're done. It sits there. It's like paying in a certain amount to an investment account, and then you just put it away and don't think about it. It's going to grow in value. Potentially, it's going to earn returns, and it's going to have a larger cash value, but you don't have to pay in. You can also pick to stretch it out. You can pick a 20 or 30-year period. Obviously, your premiums would be smaller, but you're only still going to pay for a period of time, and then it's going to be put away. Essentially, most policies are paid up when you reach a certain age, around that 65, 70 years of age. And then basically, you're just getting that cash value. You're kind of caught up. You paid in to the insurance company what they deserve to pay them back for the risk, and your value starts accumulating faster than the amounts that you're paying the insurance company to cover their risk. If you really have substantial dollars, you could go buy a single premium whole life insurance policy. That is, I'm going to pay a one-time payment, and I'm going to get a policy at a certain fixed value in the future to cover me for the duration of my life. In order to It's like putting money in an investment account saying, I have so much money, I'm going to put in a one-time payment, it's going to grow. If you have the amount of money to put in a one-time payment, you probably could have done something else with the money. And you probably don't even need life insurance for that matter. Another option would be endowment insurance. Basically, you have stipulated what you want to happen if you're paying in, and if you die for that first part, that death protection, you want to make sure that your beneficiaries are covered. But maybe once you reach a certain age, you have a different choice. You want it to now pay you out after the period of time's ended. Maybe you say, get me through to my last child is a certain age or until I get to the age of 65. And at that point, I want it to be paid out to me. Again, it's an investment, but you select what you want to happen. So in the endowment, basically you're saying, this is what I want to happen with the dollars that I'm paying in. It gives you two pieces, but very few people buy this kind, only 1%. Variable gives you the flexibility to be able to invest the money. So you're paying in your premiums to the insurance company, and usually they do all the investments on the side. You don't have any idea what they're investing, the monies and the premiums that you paid in, where they're investing that money. If you want to have a say and you want to dabble in it, you could buy a variable life policy, which again, it's just another type of whole life insurance policy that has fixed premiums and has a savings component. By being involved, and if you're a good investor, you could actually maybe increase the returns and increase your cash value sooner by participating. Again, the premiums are level, but the amounts that are paid in are always going to be invested. You just get some choice in what they're invested in. That amount that you're paying in has a separate account, so they can account for whether you've done better than your peer who bought the same type of policy. And the unfortunate thing with it is if you do really well, you're going to get better cash value returns. If you don't do well, you're going to have a lower return and may never ever get to a positive cash value. There's nothing guaranteed in some other policies, whereas if they're taking on the risk and promising that they'll at least return a 4%, you're going to get 4%. In this case, nothing's guaranteed. Universal life is another option. Sorry, I'm just catching up on my slides here. It's another option where you have the flexibility. Maybe you pay, you don't know how much money you're going to have when you're younger and you're just starting out. You make a lot less salary. Maybe you start out of college at $50,000 a year with the hopes that maybe by the time you're at the age of 35 or 40, you're going to be making double that or triple that. That allows you, you pay that first premium. They tell you how much it is, and they give you an advisory. Here's how much we recommend you pay in, but it's not fixed or required. So you decide how often you want to pay in. Maybe you got a bonus and you want to pay in more. You can pay 2 or 3 times a year if you choose to. It's just stocking away more money into the policy. Like I said, they give you a target. They say this is the minimum we think you should pay. It's kind of like paying off a mortgage earlier. They tell you what your minimum target premium is or your mortgage payment. They really want you to pay that. A little bit different in though you are not obligated to pay this, but it's a target. The good news is if you pay in more, you're going to pay it off or get, in this case, you're going to get more value quicker. And it's really essentially unbundling the death benefit and the savings component and allowing you to decide how quickly you want to build that savings component. So some of the characteristics of a universal life policy would be getting that unbundling. There's a couple different forms of universal life, but it gives you the flexibility to decide what you can afford, and it only gives you a target. There's no requirement to contribute. If you choose not to invest and put money into that, then you're not going to have much value. It's your choice. You still get to withdraw cash at different times, but you're probably going to have less if you pay in less, and it does have some favorable tax treatment to consider. Again, there's 2 different options we're going to show. The first option is I'm going to get the same death benefit level each year in the early years, and then after I attain a certain age, it's going to start increasing more rapidly. And as long as it meets the IRS rules that allow it to grow, it has certain parameters, then you're great. The other option, it is an increasing death benefit from the beginning all the way to the end. So the amount of risk plus the accumulated cash value. So here's a visual. If you pick option A, you're going to have a $200,000 death benefit if you die in those first years until the age of 55. And then after that, it's going to grow substantially, probably because you paid in a lot of money to the insurance company and they're going to take on, they're caught up and they're going to have less requirement to cover their cost or risk. In the other case, you'll notice the cash value is going to grow over time as it does here, but the net amount at risk is not as guaranteed for the insurance company. Most likely option B would be your insurance policy is going to go from 200,000 to 400,000. So you're obviously going to have to continue to pay in higher premiums to get that additional value. Again, flexible, have the opportunity to withdraw cash, but the limitations of having a whole life policy overall or an ordinary life insurance policy is that not very many people understand what they're buying. They go to their insurance agent and their insurance agent says, you know what, you really ought to have life insurance. Let me sell you a policy. You completely do not understand what you're buying. You don't even understand that there are a difference between a temporary and a permanent solution. So you follow their advice and you buy it. It sounds good. I would highly recommend, if this is an investment solution that you're interested in, that you get a trusted financial advisor to tell you what the real rate of return is. You do not want to be misled. As the videos have said, the insurance agent's making money on this commission. Do you really want them to tell you? They get a piece of, especially that first year that they sell it, get a large commission off of what they just sold you. So it's not always in your best benefit. You want it to all be upfront, completely transparent of what you're buying. You know, go to your CPA, go to a legal, an attorney that can read the contract and tell you what you're really buying, and making sure that you get the rate of return that you anticipated and it's not hidden with all these extra fees. Okay, here's a quick review of like what goes in. So we talked about cash value, and this is an example of a $100,000 universal life policy. Let's say you're a male non-smoker. If you're a non-smoker, you get a non-guaranteed projected value, so they believe your values are going to go up. But if you want to guarantee a rate of return of 4.5, you're going to have to pay to get that guaranteed rate of return. And this one, you are not getting the guarantee, but if it continues to earn 5.5%, this is what it potentially could be. So you'll notice that your annual premium, or in this case, is $445 that you have to pay. You're getting a death benefit of $1,000 or $100,000. Actually, I think this is probably the annual, or it's not an annual premium, it's probably a monthly premium every year or every month for the entire year throughout your entire life that you're paying in. You'll notice in the first year, there's a lot of, you're only accumulating, you paid it $445, only has a cash value of $222 on the 4.5% guaranteed, but you're paying some other fees that you don't realize. First one is a premium expense charge. They're going to charge you 5% of your money, 5% of the $445 they're going to keep, so $22. They're also going to charge you a $6 a month administrative fee. So another $72 a month or a year. 6 times 12 is $72. That's another piece that they get to keep. It covers their overhead of managing your life insurance policy. And something else that's hidden in there, another expense you have to pay, is what we call a mortality cost. So you're paying the insurance company $1.13 for every $1,000 of coverage. You have $100,000 worth of coverage, you have 100 units of $1,000 coverage. Take that 100 times $1.13 per 1,000. You're essentially paying another $113 per period to get that $100,000 coverage. So if you add up those three, you got the 5% premium charge of $22, you have the administrative fee annually of $72, and you have that $113. Basically, they're keeping out $238 of the money of the $445. The rest goes to your cash value. But you notice it's growing pretty slowly, and the cash surrender value goes up really slowly. You start, basically when you get to the age of 55, you max out at $7,000, which isn't a lot. You're paying in all those years for nearly 30 years, and you've only accumulated $7,000 of those premiums. Then it starts going down because you're getting that guaranteed rate, so you have to pay them higher return for the risk that they're taking on for that guaranteed rate. If you go with the non-guaranteed, you continue to increase. You actually have better returns by the age of 60 than you would have with the guaranteed rate. And by the time you reach the age of 64, the guaranteed value, you've paid them in so much in fees that you actually have wiped out any additional cash value or surrender value that you've earned over time. It continues to decrease until it's wiped out. And you no longer have a cash death benefit. So it's a little bit different if you do that whole universal life option. The non-guaranteed continues to grow and grow and grow until you reach the age of 75, and then it starts declining, and you actually carries you out into your 80s. To when do I want to cash out? If you're the person who's been paying in, you probably want to cap out when it's at its highest. Let's say it is the age of 75, and you probably want to withdraw that money. But if you really think about all the monies that you're paying in, it's not a huge return. And they're keeping a lot of that to themselves. So again, a lot of commissions are being paid out, and it's something you want to consider what you're paying in. Some universal life insurance policies are actually tied to financial indexes like the S&P 500, an index one. So if the market's doing poorly like it is right now, you're not going to have very good returns. Your insurance value or cash value is going to go down if the index is going down. So not a good option. It's going to go and ride with the market, which may not be a good thing. And then the last one in the variable universal. So it's the ability to have the ability to decide what to invest in, but it's also a little bit of that universal life where it's separating the savings component from the death protection. So you decide again how the premiums are invested, but you're not guaranteeing a rate of return. They typically are sold to the buyer as this is a great tax shelter, or it's a great investment. You know, you get to play and dabble in what you're choosing to invest in, and you're going to get better returns. But they have all these huge expenses tied to them that people don't realize. They have to pay commissions, and they have to pay investment management fees for someone to manage the portfolio for them. So again, not always the best solution. Talk to a trusted financial advisor before buying one of these. And if you have parents that have bought it, really dig down and figure out what is it that they bought. Maybe they don't even understand what they bought years ago. Final thing, a couple things I want to mention is a current assumption whole life. You know, you're not really participating. It's going off the current mortality they expect you to live at, the current investment experience, the current expenses that they plan to incur. And so it's based on all of those. So it's a little bit more stable. You can pick that guaranteed interest rate, whatever the current interest rate is. Let's say right now the current interest rate is 2.5%. It's going to give you that guarantee. You're going to have that fixed death benefit, but you're never really going to cap out. You're going to have a maximum premium level, and you're not always going to recoup the cash value that you anticipated. A few other variations is, let's say you have a change in your financial situation or change in your life that warrants changes. You've selected a low premium product in the early years, and now you have more money, and you want to exercise your redetermination provision that allows you to recalculate their premium after that initial guarantee period expires, and you can say, you know what, I want to reinvest it in something else. If you have that provision, it'll allow you to do that. High premium products typically allow you can quit paying your premiums after a certain period of time if you pay them on the high end and the front end of your early years, but then later on you don't have to pay as much and you can just discontinue, but it's still going to be there. This is a great chart that shows you a comparison of term or temporary insurance versus ordinary life. And remember, all of these are some variation of ordinary life. Variable life, universal life, they all are part of the whole life insurance policy with different nuances to them. So this is a great review. A couple of things I mentioned is that if you want to look at a preferred risk, and I have exercised this type of policy where I'm a non-smoker, I can prove that I was fit, I want to go through a health screening. If I do that, I get better rates or I'm a preferred risk that should warrant me getting lower rates. So if you can prove that, you fall in that category, you can get a lower premium out of that. You can also take an insurance policy that's tied to two different lives, not just one individual, but maybe a husband and wife. The insurance policy won't pay unless the second of them dies. So maybe the husband dies, and maybe a couple of years later the wife dies, and then whoever is the last survivor, it would then pay out the life insurance. But it ties the two of them together, so their heirs would get whatever that face value would be. I'm not going to focus on the first two in this last other type of insurance, but I will ask you or mention that the group life insurance is probably the most likely thing that you guys will get the first time you buy life insurance or have life insurance. You get your first job out of college, you start an employer, one of the common benefits you get is life insurance. They either going to pay a part of it or they're going to give it to you at a discount. And those are group life insurance policies. You don't have to have a health screening. You are automatically pooled with all other employees. So if you have a company that has 5,000 employees, every one of you can get into that group life insurance policy. You don't have to prove your health. Some are going to be healthier than others. Some are more likely to die than others. But overall, the risk is spread across multiple people, and you get a fixed rate depending on your age. And a lot of times it's fixed for a long period of time. So it's a great opportunity to buy in at an early age. Usually it's based on your annual salary. So sometimes insurance or your company that you work for might give you 1 or 2 times your annual salary in life insurance. So if you make $50,000, you're going to get either a $50,000 policy or $100,000 policy, and they'll probably give you the option to go out and buy additional layers. So I want 4 or 5 times my annual salary, so you could buy up and pay additional monies for that. And that's it. That's all I wanted to cover on whole life. Sorry it went on a little longer, but go back and look at those videos. But the key thing, I don't want you to get involved in all the what's the difference between a universal life and variable life. Really want you to focus on what's the true difference between a temporary policy like term and a whole life or ordinary life insurance policy that has that savings component. What am I really getting? And understanding what is the right product for you or your family member. Have a great night. Talk to you later.